I think you actually hit the nail on the head a few moments ago when you said everybody predicted a big rise last year and we saw what happened. So think of the Australian market so dominated by a few, the All Ords specifically, is dominated by a few large cap shares. Look at BHP, Rio Tinto, the big banks. They are such a large part of what the index does is relying on them. And if you look at how they'll perform, it's really a macroeconomic story. BHP and Rio, very beholden to China and the spot prices and the long-term prices for commodities like iron ore and coal, especially, and oil for BHP. So how the Australian market will go, you can largely say will be very dependent on what happens in China, and we can possibly talk about that later on, and if you're a believer in the China story or not, and what effect that will have on the Australian market. And the Australian banks are a different story altogether, and how safe are their earnings streams coming on based on their loan books to property. So what my feelings are, I don't like to predict the market, but I'm, as always, very bearish on the short term, and I think the China factor and US and Europe would be extremely strong determinants of what will happen here in the next year. And any analyst that says it's going to go up 13%, well, I wouldn't be taking their word for it.
Adam, do you think, though, the potential is there? I mean, you speak to a lot of brokers and fund managers, and they sort of almost ad nauseum talk about the sheer volume of cash on the sideline, just looking to park itself in a higher return sort of investments, many suggesting equities will be that. I mean, could you see people talking about a 3 to 6 month timeline? After that, we could see a wash, if you like, of liquidity back into the system, especially, I suppose, if we get some sort of coordinated central bank action.
You often hear that, and people saying that as the US market was falling and as the US property sector was falling. So I take advice from brokers like I take advice when I buy a new car from a car salesman. They've got a job to do, and their livelihood relies on volume. So they're the last people I'd be listening to when it comes to market trends. Some brokers might provide some good background information that you can use to determine your own intrinsic values, but I certainly would listen to a broker. And I hope people watching the show take what their brokers tell them with a grain of salt, because their job involves getting you to buy and sell equities. And really, as a long-term investor, or as an investor, the last thing you want to be doing is trading, because there's transaction costs.
Chris, your thoughts on that materials and energy space, but the other areas of the market that you think worth keeping an eye on?
I guess you can look at what M&A, as I'm a former M&A corporate lawyer myself, going back a few years, but most M&A tends to not add any value at all. There's a bit of a transfer from the acquirer to the target, but generally the only winners from M&A activity are investment bankers and, to a lesser extent, lawyers. So it's bankers that often push M&A activity. I should also add actually managers of the businesses, because most executives are paid based on the total size of the business they control. So obviously if you merge business A with business B and go from a 2 billion to a 4 billion market cap, suddenly the CEO of that business is getting paid more because he's managing a bigger company, rightly or wrongly. Many would argue wrongly. So much M&A is driven for the wrong reasons. If you look at the Foster's takeover last year by SAB, that was largely because Foster's management had done such a bad job that SAB thought they can do a better job. So ultimately, you'll get the odd takeover or M&A activity that does add value from real synergy. They're usually smaller bolt-on acquisitions, but in the whole, most M&A, and you look at the extreme example of Rio Tinto and Alcan, is destroying $10–20 billion of shareholder value there. Most M&A doesn't actually benefit anybody except for the bankers. So they'll be pushing for it, and you read the Fin and the deal book, and they're saying M&A bankers are predicting a big year, but of course they are. It's their own book they're talking. But whether shareholders benefit from this, that's very unlikely.
What about then, Adam, retailers? Obviously have been in focus, the Boxing Day sales. We got the consecutive rate cuts. Still, though, it seems awfully a hard time out there. We look at the latest sales figures for that festive period. Nothing really to be screaming from the rooftops about.
Retailers are also facing the twin or triple problems. Obviously, the first problem retailers are facing is a new paradigm that for decades consumers spent more than they earned, and it's switched around in Australia as it has in Europe and the United States. Suddenly consumers actually woken up to the fact that you can't spend more than you earn. People call it austerity, others call it common sense. You can only spend money that you've got. So consumers in Australia are now saving upwards of 5% plus, as they should be. But that gets felt by the retailers, who are benefiting from this wanton spending that happened in the last 20 years due to largely expansion of credit. That's then, you can flow on to the fact that their business models are being massively interrupted by global purchasing and the fact that it's a much more transparent marketplace for goods now. So whereas previously retailers could virtually price things how they wanted to, 50%, 60% margins quite easily, these days, suddenly you can buy something on the internet for half or less the price, even including the shipping costs. Suddenly the models that retailers use, which was very high rents, very high advertising spending, very high wages, suddenly don't make any sense at all. So they're facing this dual problem of partly their own doing and partly, you could say, sort of bad timing. That's a disastrous effect. And even well-run retailers like JB Hi-Fi have had disastrous results, and then poorly run retailers like Myer, actually that's not true, Myer's been very well run under Bernie Brooks, but traditionally less well, have felt it a lot more. So it's a very difficult stage for some of these retailers, and they've got to get their online models right, as the US counterparts did sort of 4 or 5 years ago.
Chris, obviously is the sheer volatility of sentiment around Europe, and it seems very much driven on a day-to-day sort of agenda. I mean, overnight we saw a friend bond auction. There was good demand, but still yields went up. We saw a run on Spanish banks because of a lack of capitalisation for them, and also Hungary, issues with the IMF looking for help there. It's just a raft of issues almost daily.
I think that the main issue is there's just too much debt and not enough income. I guess you look at a country like you look at a household and focus on some of the worst offenders like Greece or to a lesser extent Spain and Italy. And they've just been living outside their means for years. A country effectively issues bonds, and that's the promise to investors that they'll repay those bonds from future taxation. And the issue that the investors have finally started to realise, and investors being European banks largely, is that these economies don't have the capacity to repay the interest from future taxation revenues, because the economies can't sustain it. And it's the reason, I guess we discussed this last month, and the reason why these banks have foolishly lent all this money to the pig countries was because the Basel II requirements allotted a lower risk weighting for sovereign lending than other lending. So if you're a bank, if you're Societe Generale or BNP and you're lending money to the Greek government, under Basel rules, it wouldn't allow any risk weighting to that lending, when clearly they should have allowed a very large risk rating to that lending. That encouraged banks to lend foolishly to these countries to goose up short-term profits and pay their executives more, while what they've done is completely destroyed their own balance sheet. So that's the real problem here. There's been too much bad lending, too much borrowing to the wrong countries, and that mess has to be cleaned up, and it has to be cleaned up through default. And through writing off bad debts. There's no other way, and they're just kicking the can down the road again and again and again. And now the latest kicking of the can involves the ECB borrowing money to pay back the borrowings of someone else's borrowing. So it's just a disaster until it gets cleaned up properly. It's going to keep happening for years.
Well, I was going to say, Adam, I mean, where does that leave that ECB plan, that LTRO to lend cheap cash to a lot of the European financial institutions to then go and buy the debt of a lot of these countries that they'd already been burnt on?
Yeah, good question. It's a question. Eventually, people wise up and realise it's a stupid idea, and they usually need to get a month or two grace till that actually happens, and there's another crisis. So people stop. Eventually, people just simply stop buying bonds at auctions, as you were talking about a few minutes ago, and governments have no choice. If you can't raise the money and you can't keep paying off it's like a Ponzi scheme in a sense, that you're using future capital injections to pay off your previous debts, and it isn't sustainable forever. What they've got to do is balance their budget, so to speak, so that, and this is where the austerity comes in, but the problem with austerity obviously is that you're also reducing the amount you earn because you're spending less. So it's a difficult situation. It's not something that can be solved by lending more money. It's the old adage, if someone's drunk, you don't give them another drink. It might be a short-term solution, but ultimately they become a bigger drunk.
Chris, how do the preeminent theme? We're starting to get a lot of positive US economic data. We were getting it late last year. We got some more overnight in terms of the US labour market, if you like, in jobless claims and a private jobs report. Obviously, the non-farms Friday night come out. But do you think we could see maybe the US story start to overshadow the concerns out of Europe, or is that a bit of a pipe dream?
No. I think the US is probably in more trouble than many European countries. The US has the benefit of having a printing press, which many individual European countries don't have. And the US has been printing their way out of trouble for the last year or two. and the US employment figures are dubious at best. It's not quite China, but they're...
So you're not a believer in this sort of, this recovery, if you like, or some suggesting it's beyond a recovery, firming sort of strength in the economy?
No. US property prices still have room to fall. Most people predict they'll drop another few percent at least. US unemployment in real terms is around the 16, 17, 18% mark. Their long-term unemployment's at record levels. So people who have been out of a job for 9 months a year is at record levels. There's a huge amount of... The US as a nation, the way it's sort of transformed from the capitalist ideal to, in many ways, largely socialist-based sort of economy, with the spending that gets done on very many areas being just affected by lobbying and private interest groups, and it's not necessarily the most efficient allocation of resources. And looking at a global sense in the US, it's hard to see the US really getting back to its previous strength with the economy running the way it is. It's got a brilliant tech sector, and there's certainly pockets of the US that they're still very much world leading, but there are other areas, military spending for one, which is just completely unsustainable, health spending completely unsustainable. The amount the US spends as a percentage of GDP on health is double Australia and the UK. Just the way they manage their health system is atrocious. So to see the US recover won't come unless there's substantial structural change. At the moment, a few numbers coming out that can be manipulated quite easily doesn't give me much confidence that the US is going to recover, given the massive size of its debts.
What about from the market perspective, though, Adam? Obviously, we got the last earnings season out of the US, seemed to surprise to the upside for a lot of people, showed a fair bit of strength. We have it starting on Monday next week with Alcoa. I mean, the relative health of corporate America is meant to be strong, so that must be good, I suppose, from an equity perspective.
Oh, you could argue that corporate America is actually not too bad. A lot of American companies are hoarding cash. The American private sector has deleveraged substantially. It's the American public sector that has been borrowing money hand over fist. So while since 07-08 the private sector's done the right thing and behaved quite responsibly, it's the public sector that has grown substantially. And the highest incomes in the US are in Washington DC, which is the home of the public sector. So while public wages are now higher than private wages, so while the private sector's done the right thing, it's the US government spending is completely out of control. It's running two wars that it simply cannot afford. Iraq, it's ending shortly, but whatever you feel about the wars in Afghanistan and Iraq, from a moral sense, from a financial sense, they're completely unsustainable. And that should be the main reason why the troops need to be pulled out, forgetting every other factor. The US simply cannot afford it.
Chris, what about your bashing that goes on? I mean, should the banks be pressured in to pass it on? As we know, they are not solely dependent on what the cash rate is. So, I mean, is it fair to see them having to decide themselves whether or not they pass on the full, or if anything at all?
I think the problem with the banks isn't, so the bank bashing aside, the problem with what the banks have done isn't that they, in my opinion, they haven't passed on enough of the rate cut, is they've simply lent too much money, and they've caused a massive bubble in the housing market as a result of their lending that has been on loan-to-valuation ratios which are simply too high. So what the banks do going forward, that's obviously led to very high recent profits, I should add. In terms of what the banks do going forward, what they're almost certainly going to have to do is start rationing back how much money they lend. So regardless of whether the RBA drops rates or doesn't, and one would think they're probably smart enough not to, because ultimately what that does is the banks aren't going to pass the rates on. It punishes the savers, and it rewards the banks. John Simon actually noted today in the Financial Review that the banks are running some of their loan books now at a loss, anticipating they'll be able to grab some of that margin back if the RBA reduces rates. So there'll be no benefit to the general population. But moreover, an interest rate decrease, I should say, actually penalises as many people as it helps, because obviously people on fixed incomes and savings, like pensioners, who are largely reliant on term deposits and the like, and bank investments to get their livelihoods, get a lesser income. So what a reduction in interest rate, and the media is massively at fault here in making it look like an interest rate cut is a fantastic thing for people and an interest rate rise is a terrible thing, when in actual fact an interest rate cut benefits people who have spent money and punishes people who have been spendthrift and saved money. So you'd argue that it's actually completely the wrong way around.
But does the RBA look at it as a punish and, I suppose, reward system, or rather on a broader economic issue or economic sort of perspective of looking to try and promote some sort of growth and some sort of spending and activity within the economy?
It probably does, but then you pass it on to the next point, that is consumer spending the right kind of spending at all times? As we discussed earlier in the show, that some consumer spending is, obviously it flows through the economy and it goes to retails and goes to supplies, but what you want is spending on the right productive assets, and you want spending on investment and spending in the right areas. Not to say we should have 0% consumption, but there's got to be a good balance of consumption spending that flows through to certain parts of the economy, and investment spending in increasing productive capacity and efficient allocation of resources that needs to happen as well. And that can happen through people saving money and then banks lending that money out to businesses, for example. So when the RBA alters interest rates, it alters the way people make capital allocation decisions. And sometimes a lot of central banks around the world, and the RBA is one of the better ones, but a lot of central banks around the world reduce interest rates for the wrong reasons and increase them for the wrong reasons, and you get misallocations of resources. Most clearly was Alan Greenspan's disgraceful low interest rate policy in the early 2000s, which effectively caused the US housing crisis.
Chris, do you see when they're going to catch a break? It's been a rough few months for them, lurching from one issue to the next.
Oh, it's... I've always said I feel for anybody who works for an airline, because they never seem to make any money. There's so many problems that can befall airlines, and with the exception of Southwest and Ryanair, there's a handful of very well-performed airline companies, extremely well-performed, but the vast majority, they're often state-owned, so profit or loss is hidden amongst the state books. You look at like your Emirates and those kind of airlines, that's just hidden away, and poor old Qantas has to compete with these state-owned airlines. I guess the one thing that Qantas really does have is a fantastic frequent flyer program, and I'm not talking about the frequent flyer flights, I'm talking about the frequent flyer points that they sell to banks and credit card companies and the like, and that's a fantastic business, and it's almost a question of just keeping their airline flying as well as it can. Assume you're going to make a loss internationally, especially while oil prices are high and loads are relatively low, sort of below 80%, and keep the Jetstar business is not a bad business. Obviously, Alan Joyce was the first sort of executive in charge of that. But it's a matter of Qantas keeping the ball rolling and just keeping that fantastic frequent flyer income coming along, and hoping that its long-haul international business doesn't lose too much money.
Chris, Qantas obviously thoughts on the Australian auto industry. I mean, lots of calls for it needs to be more innovative as opposed to a production line. That's simply not going to be the future here. And as we've seen, I suppose, a lot of the issues have been located around Victoria, particularly Geelong, with plant closures and then reopens and subsidies, but sackings as well.
Oh, I think without taxpayer assistance, there would be no Australian auto industry. So the question is, do we want to keep funding? Does every taxpayer want to keep funding the industry that a small portion of Australians work in? And maybe they do, maybe they don't. I think most free marketeers are somewhat offended by the notion that the taxpayer dollars are continually being pumped into businesses that are just simply unsustainable. In the original point that Mike made in terms of Mazda 3 overtaking Commodore, I think Corolla was up there a few years ago, but what's most amazing to me is that cars like Falcons and Commodores are still sold so widely here, given the cost of running them and the fact that technologically they're generally not as good as many others. So that's more surprising than the fact that it's been as high as it has, rather than the fact that it's been knocked off, given the costs and whether the Australian industry can survive without government assistance. That's the real question.
All right, and on that note, we do have to